I'm Antoine Guerra, the M&A reporter with The Street. We're here with Bob Rubino, head of capital markets and corporate finance at RBS Citizens, and we're here to talk about 5 years after the financial crisis, how the private equity industry has changed. Banks obviously have lowered their exposure to private equity, and the industry has started to take in some very sizable new assets. What's your perspective 5 years on?
Well, it's been an extremely interesting 5 years, to say the least. And to your point, the banks have been divesting out of their private equity holdings, largely because of the new capital requirements and the vocal role that are put on them. But more importantly, I think private equity has done a phenomenal job since the crisis of reinventing itself, finding the avenues of success, and deploying capital into areas that, quite honestly, other lenders have fallen away from. So at RBS Citizens, what we try to do with our client base, and we get a lot of questions about how do we tap into these new areas of liquidity and investment possibilities, we find it very easy to have open dialogues with these private equity firms, to think about where are they looking to deploy assets on the behalf of their limited partners, and steer our clients into those opportunities. So today, private equity, it's got about $800 billion of capital to deploy. It's very healthy, and they right now are very much looking to buy in companies and deploy their assets in a meaningful way.
And private equity firms like KKR and Carlyle Group and Apollo have all gone public during or in the aftermath of the financial crisis. Has that at all altered the dynamics of the industry?
Well, it has, and I think from their perspective, and not to speak for them, but the way we look at it is they have deployed capital and continue to deploy capital very prudently, but they are also looking to various asset classes for growth. For instance, some of them have set up middle market funds where they are looking to partner with middle market type clients and bring value through their investment strategies. They've also, like Blackstone, through their GSO unit, have come up with a distressed loan fund, which at the end of the day will help companies, for those who know how to access it, manage through more difficult times. And that's a very legitimate way for companies today to seek alternative financing sources.
You mentioned Blackstone and GSO providing emergency capital in some instances. Are there other areas where an evolving private equity industry really impacts C-suites and, by proxy, investors in some of America's largest corporations?
Well, private equity today owns about 25% of corporate America, and so they are very active investors. So the prudent middle market firm, that's who we mostly deal with, will understand what does a private equity firm have to bring to their table. So when they're looking at a strategic alternative, and for example, we have clients today who are looking to diversify their risk in the way they are working with new investments. They may look at a private equity partner to come in and to buy part of the firm, not all of the firm, and to help seed some of the risk in the new investment. So from a middle market perspective, what private equity brings today is a little bit more firepower. It brings good connectivity, good client know-how, and also the opportunity for middle market clients to diversify away from solely owning the enterprise.
Thank you, Bob Rubino, EVP and Head of Capital Markets and Corporate Finance at RBS Citizens. For The Street, this is Antoine Guerra.